Rohit Agarwal of Kotak Life Insurance is now joining us. Rohit, thank you so much for taking out time for us. Could you just tell us that are you surprised by the recent run-up in the market? Do you think it has surprised even a long-only investor like you?
Hi, good morning. We are not necessarily surprised by the run-up in the markets which has happened recently. If you remember or recall what we have been talking in the past, after the demonetization, the kind of money that the banking system is flush with, the kind of liquidity that is floating around, a lot of it is bound to come to the equity markets in some form or the other. And I think it is this liquidity which is driving the markets currently and not necessarily the earning fundamentals of the broader corporate India. If you see, about 1 lakh crores has about come after demonetization in the Indian mutual fund industry. And although there is no precise data for the insurance industry itself, on the new sales business premium, if you see for the last 3 months or so, has been upwards of 30-40%. What that tells us is from the amounts which have been deposited during demonetization in the bank accounts, a lot of that is finding its way into the equity markets and not going into real estate or gold. And hence the shift is happening from physical to financial, which we have been talking about. And once that money comes in, it will get deployed in the market in some way or the other. So we are not surprised by the run-up.
Right, but we don't have the exact data of insurance as you said, but what are your internal estimates? Do you think a lot of equity-based insurance units have seen flows?
Yes, that's our premise. If you look at some of the distributors of insurance who are more banking focused, the banking channel is the one which primarily sells the unit-linked products. Actually, the growth has been higher in those channels, which primarily tells us it is the ULIP-based, which is the market-facing of the insurance companies, which have seen larger inflows versus the more traditional ones, which also have seen inflows, but at the margin, the distributors, which are more banking-led, have seen higher share or higher growth rates in the last 3 months, which tells us that it's the flows which have been into ULIPs and primarily equities.
Right. What is the sense about market valuations? Of course, we are at the higher end of the market valuation, but if liquidity is here to stay, you see any major decline being bought into?
Yes. As you said, the markets are not necessarily cheap. They are a little high at the higher end. But we think that what the Indian economy is going through currently is kind of an adjustment phase or a kind of a phase where it is kind of forming a base because of demonetization and the impending GST. So the Indian economy and the corporate India is kind of tuning itself or fine-tuning itself to set up a base for the next 3, 5, 10 years to come. And currently the markets are where they are because of liquidity. But bear in mind, finally the markets are slave to the earnings. So if the earnings don't come, the markets will give in. And if the earnings start to come in, the markets will go higher. What we think is at some point in the next 2 to 4 quarters, there is a likely probability or a higher probability that the aggregate earnings estimates for the market start to move up. The moment that starts to happen, which will be a confidence-seeking measure for the investors in the equity market, you could actually see the market getting into an even higher orbit. I would not be surprised if in the next 3 to 5 years, we see a kind of bull run that we saw in 2003 to 7, especially in some of the names that people like. And since there will be a lot of liquidity chasing around, why we believe liquidity chasing around is what we have discussed earlier is because of demonetization and the shift from unorganized to organized, where there'll be more disposable income, there'll be more higher financial savings. A large part of that will find its way into the Indian equity markets. And hence, you will see probably the markets might even go into a bubble zone at some point in the next 3 to 5 years. But it may not happen right now because the earnings are not as supportive. The moment the market gets a whiff of earnings decline or earnings acceleration happening, you will see the market participants lapping up. We are already seeing that kind of money being there, right? The IPO which is opening today, people are talking about huge numbers. What that tells us is there is appetite, there is demand. If the company is right, and if the value is right, and if the future of that company or sector is right, people will chase it and it will trade at expensive valuations in the near term. But as soon as that starts to happen with the market as a whole, I think there's a lot of liquidity around, and people are waiting to jump into the market on some sort of correction.
Right. So, with this sort of earnings outlook that you've given us, plus liquidity from domestics being high, do you think FIIs this time are getting the left out feeling? They have not been investing incrementally when the markets went down. Do you think that they would be getting that left out feeling, and now they would inch to buy?
Within the FIIs, actually, you need to bifurcate them. The India dedicated FIIs or the emerging market FIIs. The feeling of being left out has not been there in the emerging market related FIIs, because if you see, India is not the best performing market in the emerging market space even after demonetization. What that tells us is there is growth, if not necessarily growth, there are pockets of growth in the world itself at large which is available right now. And hence, for the emerging market related FIIs, India has actually seen some kind of outflows. The reason for that is India has been a consensus overweight in all the FII portfolios. Last time we checked, that number was about 500 bips higher than what is India's weight. India's weight typically in the benchmark emerging market indices is about 2 to 3%. So most of the FIIs were already having 7 to 8% of their portfolios in India, which was a meaningful overweight. Now with the shift which has happened in the global economy, where the commodities have gone up and where some of the global economies have started to look up, certainly the US and some of the emerging markets which are related to the US, some of that money was bound to move into some of other geographies. And hence the feeling of having left out is not necessarily there with the emerging market FIIs. When you come to the India dedicated FIIs, there has been a slight feeling of being left out because they did not necessarily participate in the upturn which happened from January onwards. But I am given to understand that some of those FIIs have also seen outflows. Barring the outflow number, they would have missed the rally a little bit. But as soon as they start getting inflows on India dedicated funds, I think most of those funds will come back, and they will make a beeline for some of the best corporates that corporate India has to offer on the exchanges.
Right. Also, in terms of the recent block deals that have happened, the IPOs that you were just talking about, so the FII interest in those names have been very high. A lot of block deals have been closed by FIIs as well. Yeah,
that's right. So that's precisely my point. As of now, the interest is more stock specific, sector specific, and deal specific. As things start to stabilize and as the aggregate earnings in FY18, which currently again start at an assumption of 20%, start to maybe come down, which generally happens, and then the moment they start going up, you will see a beeline from the FIs as well. Bear in mind, India's macro is pretty decent. If you believe that the RBI will stick to its target of 4% inflation plus minus 2%, so assume a 3 to 5% broad inflation range, GDP growth of about 7 to 8% broad, and a positive savings rate, you will see Indian macro getting better by the day. And as India's corporate earnings come back, you would see FI interest coming back with the bang. But in the same breath, you also have to watch out what happens to global commodities. A lot of flows into India in the past were actually related to the foreign flows which came from sovereign funds and not necessarily asset allocators. A lot of the foreign funds in the Middle East, the sovereign funds of the Middle East, which had huge budget surpluses because of where the oil was, used to find that way, that money used to come to India or to some other markets where they found a reasonable growth expectation of mid-teens. Although the reasonable growth expectation of mid-teens still remains, but some of the budgets have got really delayed, and some of those same countries are now actually looking at budget deficits because of where the oil prices are. Hence, a lot of these inflows, again, exact data is not available, but we believe that a lot of these foreign inflows in the past were also a function of sovereign wealth funds, which were a function of very high budget surpluses which they were carrying because of a very high oil price. A lot of that may not come back, but the big asset allocators who invest into equities mostly, they will likely come back with a lag when earnings start to chip in.
Right. And what about the IPO markets? Do you think IPO markets continue to look strong? So since Dr. Lal PathLab listing, IPO markets has been strong. Do you still believe the pipeline is good? A lot of interesting companies are coming up with IPO?
Yes, we believe so. And I think it is very, very healthy for the markets in the near to long term. Even if you look at the developed markets, there are times when the market gets a little stale and it gets a little tired. What you need then is some new sector or a new company to come in and reinvigorate the enthusiasm that the market has, that the market needs actually. If you look at what happened in the US with the listings of the kinds of Facebook and all, there was a new era, there was a new money, there was new enthusiasm which crept into the markets. So even in India, with these new kind of companies which have not been listed in the past, the unique business models which are very good models and generate good high return on capital employed, good free cash flows, we need these kind of companies coming to the market and hitting the market and being part of the big indices. What it does is it gives the investors an option, or avenues are open for them now to invest in more sectors, more diversification. And bear in mind, every sector has a leader. Even if a sector is not good fundamentally, it has a leader. Even a commodity sector will have a leader. But if these listings come from sectors which are high growth, where the visibility for the next 10, 20 years is 15 to 20% for a sector, and then the leader comes and lists, the leader can easily grow at a higher than 15 to 20%. These kind of sectors and companies will always find good takers, and more often than not, you will actually find the valuations at the higher end and maybe a little difficult to justify, but only time will tell if they can actually deliver value over long term.
Right. So do you believe that what happened with the airline sector can happen with the retail sector as well with this IPO?
It's possible. It is entirely possible. Although we have to bear in mind that the dynamics of these two sectors are very different. The airline sector is globally considered to be a very volatile, commodity nature kind of a sector, where over the longer term you have not seen many companies making high ROCEs. There have been very few and far in between, the likes of Southwest or Ryanair, which have been low-cost models. So world over, barring the last 2-3 years, you have not seen the airline sector really make money over a longer period of time. Whereas, again, if you take the example world over, there are enough retail companies which make decent ROCEs, although the growth may have tapered out for them for being a single digit because they are more penetrated and developed market. But in India, where the growth is likely to be double digit, and if they also are able to demonstrate high ROCEs, the sector will re-rate. It obviously needs one good company to come and show you that it can be done. And what it also does is not just re-rate the sector, you will also see some of the competitors who are either listed or non-listed also being able to identify some of the loopholes or the gaps in their own business models much better, because now you have more information or data, and actually being able to challenge the leader much more effectively, and in the process becoming more efficient and of course more profitable, and if profitable, more valuable.
Right. Also, one thing different in the flows have been, I know you cannot talk about stocks, but something like a Reliance has gone up pretty well, something like a TCS has done pretty well. So do you think that low PE stocks or stocks that were trading at low PE is now what market is looking at?
Well, I do not subscribe to that view wholeheartedly. What's happening is that the market has been looking for pockets of outperformance. Now, one day that pocket of outperformance can come from a large bank due to some technical issue. One day it can come from a big oil and gas company because it has come out with plans which the market believes is better than previously envisaged. So what you see is, it's not been that it's a low PE or a high PE stock. Market has looked for some kind of a data point to go and lap up to them. It has not happened that the market has just gone and bought them. There has been a data or an incident which has been preceding to that buying. So that data or incident may come in some form or the other for any group or a company, but it is not the case that all low PE stocks are getting bought into. There has to be a specific trigger. One of the names that you mentioned saw a specific buyback, and hence the stock is kind of stabilized, not gone up that much, but kind of stabilized. And hence all low PE stocks which see some kind of an action, either corporate action or earnings action or an M&A kind of an action, will see action from time to time. And not necessarily low PE stocks, even for high PE stocks, there has been a lot of chatter about some kind of mergers and acquisitions in the financial space industry, and you do see stocks reacting to that. And this is a phase that the market will go through when the earnings are challenging, when there is not clear indication of where the earnings are headed. Is it 10%, is it 15%, or is it 20%? Then these kind of M&As, corporate actions, will always dominate, especially when liquidity is floating around. And some of the companies which are large, liquid, and have the balance sheet or have the ability to take companies which are smaller and are struggling, this is the time when those companies will make a beeline for those companies, bid for those companies, and believe that they can turn it around or make it a better company as a total company.
Right. In terms of sectors, what do you like? Can you start with the consumption pact? Do you believe that durables as a sector is still underpenetrated and will continue to do well?
Yes, absolutely. Durables in India is highly underpenetrated. If you look at some of the segments within the durables, you will obviously need to bifurcate within durables what is high-end discretionary and what is the normal durable. So the normal durable piece with a lag is now coming back, is what we are told or what we are given to understand by the companies that we regularly talk to or meet. They are trying to suggest that volume growth is back. However, most of the durable companies are going to see some kind of commodity pressures, and hence there will be some visible pressure on the margins, give or take a few companies here and there. But what is heartening to hear from them is that the volume growth is starting to come back and inching up close to double digits. When volume growth starts to inch up back to double digits and starts to go higher, a lot of fixed costs within the system are taken care of. And when the commodity prices get into the base, we have to bear in mind that at the same time last year the commodity prices were abysmally low, and hence it is more of a readjustment and not a new normal. If commodity prices were to stay here going forward with even a 5, 7, 10% kind of inflation every year, we will see some of these companies again getting back to margin expansion mode, and when volume comes back, a lot of that will flow through into the EBITDA line and hence profitability. So to answer your question again, the durable space is an exciting space. It's a low penetration state in India. You will see companies attacking that space very aggressively in some way or the other. The companies which will be winners in this space are companies which have some kind of differentiation. That differentiation is largely to do with distribution, lesser so to do with product differentiation, but you need to have both to be able to win in this market.
Right. And in terms of consumer durables, do you believe that valuations are very expensive as well? So one has to wait for a correction to buy these names even if the earnings trajectory is positive?
In some of the companies, yes, and in some of the companies, no. Because in some of the consumer durables, what happens is, at the starting point, most of these companies always look expensive. But they start to look all right or average in their multiples or valuations if the numbers come through. At the same time, if the numbers don't come through, they remain expensive and they probably go through a time correction. So I think some of the companies where the expectations are very high, which range into 20 to 30% CAGR, you would probably see some time correction or maybe a 5% downward tick. And when you see time correction after 3 to 6 months, when the GST comes in and the market readjusts to the realities of the GST, you will be able to confidently look at earnings beyond FY18 and FY19 and FY20 numbers will start getting discounted in the market. And that's when you will probably see the consumer sector, the consumer durable sector, the discretionary sector, the sector which has more unorganized starting to come back into the favor, which kind of went out of favor after the demonetization.
Right. In terms of autos, would you include it as a part of the big bang, big bang consumption space? Will auto be consumption for you?
Well, autos is a very, very different animal. If you look at autos, there is two-wheelers, there is four-wheelers, there is the passenger segment, there is UVs, there is trucks. So it is very difficult to brand autos as a consumer sector because the trucks are not consumer, but it is more economy driven. At the same time, the two-wheelers, which is the lower end of the autos, is more consumer centric. So if you bifurcate them, the lower end of consumption, which is the consumption sector that you are talking about, will probably see some uptick because of the various steps that the government has taken to reinvigorate or get the rural economy kicking in. We will probably see the fruits of it coming in the next 2 quarters or so. We have to obviously assume that the monsoons are normal again this year. Because we had a normal monsoon last year, the expectation is that the rural economy, the farm sector, the agricultural sector will probably see higher demand coming in from this year onwards. Because bear in mind that the year before last, 2 years on the trot, we had a below expectation rainfall. Now what happens is a farmer typically got leveraged till last year. Now when the monsoons were good last year, he did not go out and spend his money and consume. Since he was leveraged, that money was used to pay down his debt. Now that his debt has been paid off, now if you assume that the monsoon is normal this year as well, now the cash flow that he gets this year will probably go into consumption, and some of the consumption stocks will benefit from what we are talking about. If the monsoon is not good again this year as well, then some of the consumption stories that we have been talking about will take a backseat again, and we'll have to rework our math as to how these companies are likely to behave.
Right, but some of these auto names, some of these two-wheeler names, the EBITDA margin expansion that you gave for the consumer durable pack is also valid for these names. They are great businesses. They don't have debt. As soon as the volume pick up and the commodity pressures are stabilized, their margins and profits would come with a bang.
Yes, but you have to bear in mind that the penetration story is very different in autos versus the consumer durables. The two-wheeler industry, after reaching a certain state of penetration, grows only mid-single digits to high single digits world over. That's what we have seen. So our view is that in the two-wheeler space, the space itself is unlikely to grow at high double digits. It's more likely high single digits to very early double digits. Hence, the valuations will always reflect that kind of an environment. Whereas in the consumer durable space, where the story of penetration is still to play out, the valuations will always, at the starting point, be higher because the long-term assumptions of growth rate of that sector is high. So when a person sits around and does a DCF, the terminal growth rates that he puts in a two-wheeler company or a four-wheeler company is lower after the next 5 to 7 years versus what he will put in a consumer durable company. And hence, you will always find that the consumer durable companies trade at higher multiples, even though the two-wheeler or some of the auto companies may show a significant or the same amount of cash flows or the return on capital employed, which the consumer durable companies might show.
Right. Can you talk about sectors like infrastructure, metals? Nobody was expecting a big bounce back, but we've seen a bounce back on earnings. Do you see infra, power, leading the earnings in FY18 or probably 19?
See, I don't know about FY19, honestly, because commodity and metals is such a volatile space that the near-term commodity prices determine what kind of earnings you will get in the next quarter. In FY18, at least, some of these companies have a very favorable base. So the market is expecting some of these companies to show a 30, 40, 50% kind of growth rates. Bear in mind, it is not something which will be new to the markets or the markets will be surprised with, because all you need is to extend your Excel sheet and you would know what kind of earnings these companies should have, unless the commodity prices, which are ruling at wherever they are, start to go up even from where they are currently. Bear in mind, we have the Fed meeting next week, and some of the commodities have already actually started to react downwards. So FY19, for sure not, we don't know. FY18, some of these companies have a favorable base, provided that the commodity prices stay where they are currently. Having said that, we do not see too many pockets of value which are currently available in the market in some of these companies, because the market has, to a certain extent, extrapolated their earnings to FY18 and is hoping that these kind of commodity prices remain. At the same time, also hoping that the volumes remain as buoyant as we expect them to be. So even a slight niggle, as I call it in a more athletics term, were to happen, and if the US gives you a signal that instead of 2, what the market is pricing, there are 3 Fed rate hikes coming, which they have actually talked about 3, but the market believes that there are going to be only 2 rate hikes, because that's what they have done in the past, where they have talked about higher number of rate hikes but actually delivered lower number. Then the markets may be surprised a little bit negatively, and you would see probably some kind of reaction in the commodity prices themselves, and if that happens, in the commodity names that are there in the Indian listed space.
Rohit, thank you so much for taking out time for us. Always good to get a perspective.